Good morning, everyone. It's such a pleasure to be in Delhi. We landed last night, and I must say that you can really enjoy the chill of the Delhi weather. So, what we'll understand the chill, what we're experiencing in Delhi weather, how realistic is the chill in the economy, and when will the recent bout of slowdown, what we've seen in last 2 quarters, when will that fade away? The theme is fast track to top 3. What is India's preparedness to be really fast-tracked to number 3, and what about the big vision of Viksit Bharat of Prime Minister Modi? Now, Mr. Panagariya represents the Finance Commission, which in a sense has always been applauded for independence, integrity, and the independent views. So, Mr. Panagariya, you just heard the Minister talk about good things about India, how India is moving, where things are moving in the right direction. Now, you are an independent voice, and you can agree and disagree with what the Minister had to say. So where would you agree with the Minister and where would you disagree with the Minister? You're a Finance Commission, sir. You can give your independent views, even if you disagree with the Minister.
As a general matter, I think, in terms of the trend of the economy, its potential, where we are headed, broadly I agree. In terms of the details, we may put things differently. But the current slowdown is quarterly slowdown, and I also agree with the Minister on that, I also don't look, like many of our financial analysts, which include economists as well, think that, you look at a single, any observation comes in, oh goodness, what has gone wrong.
Sir, aisa mat karo.
I think
you'll put 18 hours out of job. We have to look at quarter to quarter.
Yeah, you see, this is the problem. My job is not 18-hour job. So, I think, we should be reading something into the quarterly growth decline. But on the whole, I like to wait and see what happens over the at least entire year. There are good reasons. You can explain why this slowdown happened. A bit more than I had anticipated. I sort of didn't expect it to fall below 6%, but it has fallen below 6%. So we have to look back as to what went wrong. But one thing we know is that because of the elections, the capital expenditure of the central government slowed down, and also, we've been looking at the states' capital expenditures actually have taken a hit as well, because lots of the elections happen in the states as well, and naturally, as it happens in the elections, a lot of promises get made, which basically are promises that involve revenue expenditure, not capital expenditure. And when those promises then begin to be delivered, that cuts into the capital expenditure. So some of that has happened as well. It's also reflected in a little bit of slowdown of credit expansion. It's still well into the double digits, so credit expansion rate is not that bad, but it has fallen from something like 18-19% to about 13-14%. So it's reflected there. But fundamentals of the economy are absolutely solid. We have weathered the COVID crisis, was a major one, and recovered out of it actually with flying colors. So I expect us to return to the at least about 7% growth. I think we also need to do something more to get to the Viksit Bharat 2047, and we can talk about that as we go forward.
This is the 10th edition of India Economic Conclave. Now, we always want to look forward, but for the audience here, I will take the clock back. 10 years ago, Indian stock markets were at 25,000. Our forex reserves were less than $300 billion. Our total size of the economy was less than $2 trillion. We were running a very high fiscal deficit. Rupee was under intense pressure and FDI had been broken. So the India of today is very different from India of 10 years ago. But where do you think we are headed 10 years from now? Hypothetically, if we are on the same forum, engaging and talking at the 20th edition of the India Economic Forum, what do you think we are likely to be discussing?
So you went back 10 years. So to answer your question, I'll take you 20 years back.
20 years.
So let's look at what has happened in the last 20 years, right? I mean, as economists, we also like to look at the long-term growth rates, how we have performed. So if you really look at India's growth rate, first, let's say in current dollars, over the last 20 years, ending in 23, 24, starting in 2003-4, that's a 20-year period. We have grown in current dollars over a little over 10%. Current dollars. Now you can use the US rate of US GDP deflator, which is little over 2%, 2.1, 2.2%. That gives you, even in real terms, real dollars, growth rate of about 7.9%, maybe close to 8%. So let's for a moment think about it. During this 20-year period, we had the global financial crisis, we had the COVID crisis, two major crises, and we still managed to grow 10%, a little over 10% in current dollars. For a moment, suppose we do just that much. If the next decade remains more normal and abnormalities that come in are not of the magnitudes that we have had before in the last 20 years. Also, by the way, in the last 20 years, we had our own banking problem, the NPAs, which led to in the financial markets troubles also, and that had led to the growth rate decline in 2019-20 as well. So in spite of all these three major shocks to the economy, we did that. So I think it's a reasonable assumption to make that at least that much we will do in the next 10%, meaning this in the next 10 years. That gets you in 10 to 11 years to 10 trillion. In fact, even if you actually want to assume that we'll grow only 8% in current dollars, that gets you to over 7 trillion. So I think prospects look incredibly good. But even, let's be conservative for a moment and say 7 trillion. That will be a couple of $1 trillion more than the next country. I mean, obviously we'll be the third largest by that, well before that, but then we would be a couple of $1 trillion ahead of our next competitor. So that, I think, undisputedly turns India into a truly, truly major player in the global economy. In the end, those are the three economies that the world will be looking at, as it is looking already, given our growth potential and where the country is headed. So I think it's, in 10 years' time, things are going to change dramatically.
So if I have to, let's say, crystallize a headline from you, before the turn of this decade, for India's GDP, what is the most optimistic number according to you, and what is a realistic and what is a conservative number for India's GDP before the turn of this decade, 2030?
This is like in 10 years.
Turn of this decade, we went 24 by 2030.
By 2030, we'll certainly we'll be well past the third, so we would have crossed that for a while. So certainly conservative, I would say 7 trillion, 6.5, 7 trillion. Really aggressive, I would say 9 trillion. It's doable because, a lot of the pieces are in place. If we do a few more reforms that are pending, I think we can accelerate. So certainly we ought to, if we undertake a few more reforms, we can beat easily the 10% in current dollars by a couple of percentage points, get to 11, 12. That'll get us to, somewhere between 9 and 10 trillion by the beginning of the 2030s decade.
Fantastic. Now for countries which have achieved this mark and which have managed this kind of growth, the recent example is China. We always compare India and China on just about everything. And the factors where I would like to again compare India's challenge is land, labor, interest, and tariffs. These are four factors which essentially will decide where we are headed. So let's talk about it. Land cost, labor cost, stroke productivity, also interest cost and trade barriers. How do you see these four moving parts moving?
Okay. So let's begin with land. to me, I think right now, this is one of the most constraining factors. Labor also, but land, I think. In India, urban land is extremely expensive. One way to gauge it is that the rental yields in most of the important cities in India are about 2 to 3%. Interest rates, 8%. There is no way you can have viable commercial rental housing, which I think is incredibly important. I mean, in the ultimate, when the economic transformation happens, workers move out of agriculture into industry and services. This also means migration of the workers from the rural to urban spaces. You need to house them. Where is the rental housing where they would go? This is where you then start creating these slums, etc. Because the migrant workers cannot afford terribly expensive housing. So urban land is a very big issue. Our urban land markets are very distorted for a number of reasons, which are all solvable, a little complicated, but solvable. Things that can easily be done. FSI in India, we are the only country where in any city, the central business district generally has an FSI of 1.4. When we allow the taller buildings, we go outside the city. But hardly any city in the world is built that way. It's usually the central business district where the FSI is much higher. And as you go into the periphery, then the FSI declines. We have done the exactly inversion of that. So that's one way to address the urban land issue. I think Bombay is beginning to now. I see a bit more, compared to 10 years ago, I see many more taller buildings. But still, not in the central business. You go to South Bombay, that's still very, no high buildings. So that's one. But also land conversion rules, both in terms of from agricultural to non-agricultural uses, but also within city from one use to another use. Buildings that, are being used for conventional industry, it should be possible to convert those into something else if economic activity points in that direction. But we don't easily allow this conversion. So that has to happen. Railways, defense, these departments have a lot of urban land under control, unused and therefore unproductive asset should be brought onto the markets. A lot of public sector enterprises, some functioning, some not even functioning, some even private enterprises have a lot more land than they need. That land should come on the market. So many different ways to solve that problem. So that's one area. Labor we can talk about. Labor laws, have been passed by the parliament in 2019 and 20. 4 codes. Those are solid codes. I think it's time to implement those. I sort of understand that the government had simultaneously also passed the farm laws, which got then challenged, and the government ultimately felt that they had to withdraw them. After that, government probably got more cautious and did not go ahead with the implementation of labor laws. But I think now, elections are over, mostly, and in next year we have only Delhi and perhaps Bihar elections. So I think this will be a good window the next year to implement the labor laws. So that trade, I think, is a little more complicated.
So trade, if I could just supplement a question. We are going to be moving to a new regime in the world. And it is reasonably okay to assume that once the new Republican administration takes over, tariffs in the world will go higher. So from deglobalization, we could be looking at tariffs war which could kick in. How will that change the global growth and the inflation and growth dynamics?
All right. So there is a certainly looming possibility of the United States going into a bit of this tariff escalation. We saw that happen in the first administration of President Trump, and he has made it clear that this is what he intends to do. Right now, we are not included among the countries that are being targeted, but it can happen. So there are 2 issues here. One is what happens to the global economy as a result, what happens to global trade. And the second is what happens directly in terms of threats of tariff on the products exported by India to the United States. So on the first one, look, at the end of the day, I see that global market is an extremely large market. We have had problems, including COVID, for instance, but global trade has continued. Also, the embargoes, etc., against Russia. Right? There were all these restrictions imposed on Russian trade on Russia, and also on countries that do business with Russia and whatnot. So you had all these actions taken, but global trade has continued to grow. So pre-COVID peak was 19 trillion for merchandise exports. Post-COVID peak has been 25 trillion. From 19 to 25 trillion soon after COVID was over. Services trade, again, from 6 trillion peak pre-COVID, it's gone to 7 trillion now. So it's still an extremely large market. And the profitability is a huge incentive. So the determined exporters have found their ways around these embargoes and restrictions. And I would argue that this will still happen. So we should not be ourselves pessimistic about this. A lot of the problems that we face are our internal, meaning land issue and labor issues that we have talked about, our own high trade barriers as well. So those are the issues that we need to solve. Our share in that large global export market when it comes to merchandise is still less than 2%. In services, we are a little closer to 4%. So services, we are more decent, but merchandise is still very large, That's a $25 trillion market. So that's what we have to acquire. So a lot of the things that we actually need to do are our internal economic reforms. As regards the restrictions, potential restrictions on our exports by the United States in the future, which will reveal itself, I imagine, over the next year or so. We need to be cautious. One of the things certainly we can do ourselves is, given the fact that our own liberalization is good for us, we could react by preemptively bringing our barriers down, right? I mean, the complaint of the United States of Donald Trump is that if you impose high tariffs on me, I will impose similarly high tariffs on you. But to the extent that in any case we have been thinking of our own liberalization, we ought to react by, or even preempt by bringing our own tariffs down or committing to, it may be done over a period of 2 to 3 years. The other action that we can take in anticipation is our ongoing negotiations with the United Kingdom, with the European Union. We have been in the free trade area agreement talks with both of these countries or entities. I think that's something we ought to proceed to complete. That clearly is a no-brainer, meaning that, that's something we ought to do regardless of what the United States does or doesn't do. Overall, I take optimistic view because the United States also sees that geopolitically, India is very critical to the United States, and therefore I think the United States is also going to be a little more careful in what it does economically with respect to India.
We are talking about growth, we are talking about momentum, we are talking about a cyclical slowdown. But if I look at basic categories, the Indian economy is going through what could be called as a K-shaped economy, which is that the latest data is indicating soaps are not selling, shampoo bottles are not selling, two-wheelers are not selling, but luxury cars are selling. Rich are getting richer. In the path to move to 7 trillion, then 9 trillion, 10 trillion, if the basic bottom end of the pyramid is not growing, then the mass is not feeling happy about what is happening in the economy. So why is that everybody is excited about India's growth, but the reality is, yesterday we got a headline from Godrej Consumer. They are saying sabun nahi bik raha hai. We got a headline from Marico saying that soap, hair oil nahi bik raha hai. So what is happening?
So this is the financial analyst talk. Focusing on what is not working. We economists would not work on policy unless we are optimists. So I look at what is, the hand that's going up. But actually, I even disagree with this. Individual products and particularly individual companies that are talking about it, they may have their special issues. Question is, what is the aggregate of what is happening? There I don't see any K. Because as we have grown, again, the last 20 years experience, as we have grown, we have lifted all the boats. The poverty actually, which was, removal of poverty, which was our objective from the Nehru period, from 1950s. If you go back, read Nehru's Discovery of India, 1945 is writing, that what I want to do is overcome India's appalling poverty. Well, ultimately it is this growth of the last 20, 25 years, which has actually led to the major reduction in poverty. And if we look at the extreme poverty, the Tendulkar poverty line that we normally use, pretty much we have eliminated it. Maybe there is 2 or 3% left. There are pockets that may have been left, so they have to be not targeted more directly and all to deal with. But there is no K here. We have lifted the boats. I think, when you say that inequality has gone up and billionaires are becoming richer and the poor are getting poorer, that gets a lot of attention. But that's really not true. Yes, billionaires have come in, and if you look at the distribution, if you look at the inequality in the sense of top 1% as a proportion of the bottom 5%, yes, that inequality has gone up. But have I brought up the bottom 5%? Yes. Bottom 5% are today doing, in absolute terms, a lot better. That, to me, any day is far more important than the inequality which is brought into the discussion as the red herring.
My last question is, I'll request you to perhaps blend in your experience as an academician, as an economist, as a government summit now, and also as an investor. There are 3 items of Indian savings, Indian household savings: gold, real estate, and equity investing. For a 10-year view, if the audience here and our viewers, if they want to really choose between the 3 items of a balance sheet, savings, which is real estate, gold, and equity or stock market or debt market, where do you think they should invest?
Well, gold basically is a largely unproductive asset. So I generally don't encourage investing in gold. You can speculate on it, but it doesn't lead to productivity. So if you were to pick one, actually I'd pick equities. Over a 10-year period, if you go for equities and stay in equities, you don't have to be every day changing your portfolio, etc. Even a random walk actually in equities will beat anything else any day. Real estate is more specific. That would depend on where do you invest in, urban area or rural area, semi-urban, tier 1, tier 2, etc. So real estate is a little bit different. You've got to study the specific market because, it's a large investment, and therefore diversification, that I invest in 10 different cities in real estate. Unless you got the financial instruments to do it, diversification is harder. Equity, you can do diversification much more easily. And therefore, I think for a common investor, that is perhaps a lot better instrument to go for.
So before I wrap it up, I just want to set the context for this house here. On the first edition of India Economic Conclave, the Sensex that day was 25,000. The total number of demat accounts in India were 3 crore. India's GDP was less than $2 trillion. The composition of savings was very different. Today, the number of billionaires, the number of demat accounts, the number of SIP holders, everything has been unique. And there's every reason to believe that what has happened in the last 10 years, the forces of economy and the forces of entrepreneurship are so strong that in next 10 years, it will be better than this. Can I wrap this discussion on this high note?
Sorry, repeat the question.
Can I wrap the discussion on this high note that next 10 years will be better than the last 10 years?
Oh, of course. Of course. No, this is also very simple actually why they will be better, because the base on which we are working today is much bigger. And growth rate of that on that base is not going to be any lower than what we have experienced in the last 10 years. So absolutely, I think, there is no question about that.
So Aisha, it's no longer quarter to quarter, no longer QSQT for everybody here. It is now decade to decade.
Yes, and on a daily basis, pay less attention to the financial analyst.
Yeah. So DOT is a new word, at least, which we should really focus on. Thank you, sir. Thank you very much. Let's put hands together for Mr. Arvind Panagariya.
Thank you so much, Mr. Panagariya and Nikunj, for giving us that very comprehensive and very insightful discussion. Thank you.